What's going on, everybody? Welcome back to another Granularity AI tutorial. Today we are going to run into something pretty interesting called the Monte Carlo simulation, which is used in financial engineering, financial stock market prediction, stuff like that. So I've been kind of looking around to see and discover in my own portfolio kind of how to make better decisions when it comes to the stock market, how it can be more or less predicted if pricing can be predicted, and how to kind of maybe mitigate volatility, especially in the climate we're in, where now a lot of decisions are being made. Surprisingly, my portfolio has been doing pretty good actually, but I don't believe that the returns, the good returns I've been getting so far can last that long. So I kind of want to know what might happen in the future, what could happen in the future, and Monte Carlo can kind of help us get us there. If you have a portfolio, or if you're looking to figure out how to kind of create projects that you can use, not only for your stock portfolio, but also just for your financial engineering portfolio, Python portfolio, whatever it may be, this is a video for you. So let's hop into it. As you can see, I have OpenAI already here. Now, the reason why I have OpenAI here isn't necessarily because this is going to turn into an AI project, but we are going to include AI in this. Reason being is nowadays, right, AI can not only be used as something for agents or agentic AI, but the OpenAI LLM, GPT 4.1, GPT 4.0, GPT 5, whatever you want to use, can definitely be used to explain the results you are getting from these Monte Carlo packages or Monte Carlo simulations you're doing. Now, what I want to explain is this opens up the floodgates for anyone and everyone to become their own financial advisor, right? Or for AI to become more or less their financial advisor by explaining the results that they just got from the results from the Monte Carlo simulation or any kind of algorithm you're using for development. So we're going to use AI more so as this explainable tool for our results. But so I have OpenAI installed here as a pip package. You're gonna run this. I think it's already ran, so I don't gotta install it again. But just for the sake of the video, we're gonna run it again. Now, I also want to state that I am not a financial advisor. I am in no way, shape, or form a person who you should take financial advice from. I'm just here trying to provide you solutions as to what avenues you could take. Now, first, let's kind of see if we can get a definition on what Monte Carlo is. So Monte Carlo is like running thousands of what-if games to guess how a stock might behave in the future. You start with today's price, then use random changes like rolling dice to simulate what could happen each day. Maybe the price goes up, maybe it goes down. After repeating these many times, you get a big range of possible outcomes showing how much you might gain or lose. Traders use this to understand risk and make smart decisions, because while it can't predict the exact future, it shows how likely different results are, kind of like a weather forecast for money. So this is basically to determine, again, creating simulated situations of many different cases to see what the future could look like. Could, emphasis on could. Treating it like how potentially throughout the week, here's what the weather could look like, right? It might rain, it might be sunny, there's certain percentages of chance that it might rain, there's certain percentage of chance it might snow, that it might be sunny outside, so forth and so on. It gives you percentages of chances. Now for me, I am someone who loves the statistics of chance, right? There's a 45% chance that this could happen. There's also a 10% chance this might happen. And there's a 5% chance this might happen, and there's another 40% chance that this might happen. I like those options, right, to determine which route might give me the best chances that I might get moving forward. This is where Monte Carlo can help you tremendously by giving you options and telling you, here's the higher quartile of what could happen, here's the lower quartile of what could happen, but here's the average majority of the time. So now that we kind of understand a crash course basis on what Monte Carlo is, I want to also state that there's something called Markov chains that I've learned recently. Highly recommend taking a look at it. It was a video that I kind of stumbled upon, and it's Markov chains is this way of predicting different things around the world. Maybe not everything, but a lot of things. For example, it might predict like the next word a person might say. I think in LLMs, Markov chains are used. I don't know if it can be used for weather or you know, stocks, but I know it's mainly behind the, or it could be behind the transformer attention mechanism that is involved in transformer architecture, right? That might include Markov chains within it. But anyways, I'll include the video to Markov chains. It's a really cool video. They explain Monte Carlo in that as well. Highly recommend checking it out. I'll probably leave a link in the description. Now, if any of this sounds interesting to you, please make sure you hit that subscribe button. Make sure you hit like. Make sure you leave comments, dislike, maybe you like, right? It's all I ask is that if you do dislike, please make sure you leave feedback. Please make sure you leave feedback so that we can understand how we can do better, how we can provide a better video for you in the future, and what might help you more so in your career. Let us know. But anyways, now that we kind of got all that out of the way, the financial advisor piece, the Monte Carlo piece, and the subscribe and like piece, let's jump into the packages. So right here we have NumPy, Pandas, Matplot for the visualization, OpenAI, and GetPass. GetPass I just used so that none of you creepy critters can see my password, my OpenAI key actually. I think I gotta do a new one. Here we go. Let me get that real quick. There we go. And let's paste that in here. Cool. Now let's make sure everything's all good. Cool. Now, here's the, I have some of this copy and pasted. GBM stands for, I forgot what that stood for. But GBM is a type of, I don't want to say optimizer, but it's a way to do the distributions for Monte Carlo. Now, GBM stands for Geometric Brownian Motion Model, and again, it's used to model the stock prices that will be reflected and give that visual that you want out of the output. So the main things that we want to pay attention to here is these variables here. So we want to pay attention to this one first. I think this is sigma, I believe, and then mu. No, that's not sigma. This is the starting stock price. My bad. Starting stock price, sigma's here, and then the, what is this? This one is time, steps, and number of simulations. I think, yeah. So the starting stock price can be whatever you want, whatever stock you're looking at, while the mu is your expected returns. While the sigma as well is the volatility, the T stands for time horizon in years, steps is the number of time steps in the horizon, and NSIMS is the number of simulations that you're using for your trials. So again, you want to do time divided by steps. That gives you DT, blah, 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 blah. These are all calculations I don't really want to run through that much because this involves mathematics that I'm not super well versed in. But again, either way, once you kind of run the check, I think I had a mix of ChatGPT and a mix of actually manually going through Stack Overflow kind of create this to figure out the best kind of detail to put this together with. But it can be very, let me delete this real quick. This from a past one. But yeah, I had a mix of ChatGPT kind of build this out, plus a little bit of Stack Overflow to kind of, well, Stack Overflow I tried, and then had ChatGPT correct it. So it's a mix of both AI, both my own writing, to kind of figure out how to kind of create this. But let's see if it works and see if we can get maybe a result. So then after this, we want to include the explain the results using our GPT model. So def explain GPT, explain with GPT. Results, put it to a dictionary. Oh, boom, boom. and then string. And then we want to make sure our prompt, whoops, if I knew how to spell, prompt equals. And I already have a prompt created, so I'm just going to kind of copy and paste that here. And then we can kind of run through it together. Also, I will include this code in my GitHub that you guys can take and use. So don't worry, don't stress. I want it all to be free for you guys. So you are a financial analyst. Interpret these Monte Carlo simulation results for a stock price projection. Expected price with results, mean, median, 5th percentile, 95th percentile. Explain in plain English what this means for an investor. Be direct and offer suggestions. Now, again, I am more so, if you are involved in like stocks or portfolio management, whatever it is, I am a retail investor. I trade options, nothing too crazy, nothing too serious. I've never done day trading. I'm not in private equity. I don't know any hedge fund investors. This is strictly just for my own kind of curiosity, my own fun, and to kind of generate my own returns just because I am curious about the stock market. And like I said, so far, for anyone out there, if I had to tell you the best, again, I'm not a financial advisor, but if I had to tell you the best financial advice I can give is AI has made it super easy for you to make smart investments on your own, right? If you're somebody who likes to research stocks, likes to pick your stocks, likes to create your portfolio by yourself without kind of having a broker involved, 100% use AI, use Perplexity AI, use ChatGPT, use web search to really do your due diligence when picking a stock. That doesn't mean it can forecast a stock for you. Again, you may have to create certain logic and algorithms for that to really do it. Again, I have a video that I probably will post it into or tag it in the video here, that involved quantum computing using Qiskit, I think it's called, from Microsoft, where you're able to do like portfolio management and volatility and stuff like that. It's a really, really, really good piece of code or notebook of code to do portfolio optimization. Highly recommend checking that out. But use AI for trading options for just retail investors. If you're someone who does not want to hop into that, again, I'm not a financial advisor, but index funds, highly recommend checking out index funds. You put a lump sum of cash in it every month, every year maybe, and let it kind of ride the index of the stock market, and you basically generate gains regardless. Whether you win or whether the stock market's up or down, you generate gains forever. Anyways, that's just my friendly piece of advice when it comes to, as someone who likes to be in the stock market, what you should or shouldn't do. Just as someone who's made mistakes in the past when dealing with stocks. So anyways, client.responses.create, and let's do model. So we're going to use GPT 4.1 mini for this. GPT 4.1, 4.1, I think it goes like this, mini? Can't remember, it might be like that. Either way, if it's not, I'll get an error. Now, I don't know if anyone has noticed so far, but the new way to write prompts, or the new way to connect with the API, isn't using messages anymore. Instead, it's input, which I kind of like better. I feel like the way the messages thing, it was kind of complicated to me. I don't know, like the role in the system and the user piece just felt so annoying, if I'm being completely honest. And I forgot the commas here. Maybe that's just me rambling and giving my critique. So anyways, we have now our model set up to act as our financial analyst. Not necessarily our advisor, but just as an analyst, checking our stock, seeing what the results are of the Monte Carlo algorithm, and seeing what it kind of spits out. Now, one thing that I do want to say here, and I'm going to copy and paste because it's the larger part of the code. One thing I do want to say here is, depending, depending on the returns you're looking for, right? You can experiment with this where, let's just let me copy and paste it in here real quick for you to see. Here. So, like was done before, this is your starting stock price, $100, 100 per share is the starting stock price. This is the return percentage annually, right? The expected return percentage annually. Volatility 2% or 20%, sorry. Time 1 year, steps, blah 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 blah, and number of simulations. Cool. So one thing I want to point out here is on average, the annual return for anyone's portfolio, again, unless you're some type of hedge fund, unless you have some type of secret algorithmic logic out there that can make you have immense returns, right? Higher than 7% or maybe like in the double digits of returns, right? Average majority of the time is 7%, 7 to 8 usually. I think it has been like 9%, but 7 to 8% usually. So that's why we want to keep it at 8% here. But let's say like we want to take, let's do a quick lookup. What is the price of Moderna stock presently? Let's get their stock price and see what it is when we plug it into our Monte Carlo algorithm. So you see 28.49. So we're gonna plug that in here. Everything else can really stay the same. Again, if you're looking at it for more than a year, that's cool. Usually, like we might try 5 years after this versus just this 1 year. But usually, like, people are just looking maybe for 1 to 5 years to see what the stock might generate. Number of simulations, 1,000. We will run through as many as you can. Again, over time, like, you don't really need too many. Like, over 1,000, I think 1,000 is usually the general case. But 500, maybe 1,000 is kind of what I've seen what people use majority of the time. So we're gonna run this real quick, and then at the bottom of this, we want to do, or under this, we want to do if underscore name, and then GranU MC. There you go. GranU MC standing for Monte Carlo. So now, what should happen after we run this is not only will it pop up a graphic that you kind of saw earlier, not only will it pop up a graphic, but it will also have the explanation as to what the results mean for you as the investor. So let's go ahead and run it real quick, give it some time. And also, I don't know if you guys noticed, but I kind of moved away from using Google Colab, and I'm now kind of using Databricks here and there. And I find it way more useful than Google Colab. Both have their strengths, but I'm such a Databricks fanboy that I had to. So expected price, the average, it's based off the simulations here, right? Expected price, the average looks like it's about $30.40, maybe 41 cents if you want to average, round it up. Median price, $29.75, $29.75, which I think it is 28 right now. Fifth percentile, which I think this is the lowest percentile, right? I think that's means, yeah, lowest. Okay, fifth percentile, 21. Lowest price it could be 21.7. Highest price, 5% chance that the highest price could be 41.74. So there's a 5% chance that the lowest price could be 21.7. There's a 5% chance that the highest price could be 41.7. And here's kind of it. This is where I want GPT to come in, giving us more of like a comprehensive explanation. These Monte Carlo simulations give a range of possible futures price for the stock based on random scenarios. Expected price, $30.41, the average outcome for the model predicts. The median price, 29.75, means half the simulations ended below this price, half above. Fifth percentile means there's a 5% chance, could be this low or lower. 95th percentile means there's a 5% chance that this could be high or 41.74 means there's a 50% chance the price could be this high or lower. What this means for you as an investor, most likely range for the stock price is roughly between 21 and 41 in the time frame used, with a central tendency near $30 median price, or no, expected price. Yeah, expected price, mean. There's a reasonable chance, 90%, the price will fall between those two percentiles. However, there's a 5% chance the risk price could drop below 21.70. At the same time, there's a 5% chance. Suggestions: if you are risk averse, consider whether you're comfortable with this potential drop to 21.70. You might want to set a stop loss near that level, or consider a smaller position in size. If you're seeking growth and willing to accept volatility, this range suggests a good upside potential, so holding or adding shares could be reasonable. Always balance this probabilistic outlook with other factors like company fundamentals, market conditions, and your investment goals. Use this simulation as one tool among many, not the sole basis for decisions. In short, this stock has a decent expected value of around $30, but with meaningful range of outcomes. Be prepared for volatility and manage your risk accordingly. Interesting. So now that we did 1 year, let's try the time, the T variable. Let's try it out for 5. Since we know, again, starting stock price here, expected return here is 7%. Again, this is expected. The sigma here is the volatility, 20% of the time, volatility. Or let me see, I wonder what percentage of the time should I expect volatility in the stock market? Let's try this and do our own learning together. Is it 0.2%? Is it 0.2? Let's see what we get. Not exactly 0.2. Here's the breakdown. It isn't the percent of time volatility, it's the magnitude of volatility, not its frequency. Here's the breakdown. When you see something like that's called annualized volatility. It means the stock's returns how much it is going up or down tend to vary between so it's not saying the volatility happens 20% of the time. Volatility is always happening every day. The 0.2 tells you how wild the swings are expected to be. Think of volatility as how often the roller coaster moves, not as how often the roller coaster moves, but how big the drops and climbs are. So we're expecting the drop to at least be 20%. I see, in the volatility. Okay, so let's try 5 years with still keeping the volatility 20% in terms of not necessarily how often the volatility happens, but how big the drops are when volatility does happen. Got it. So let's now take it from 1 year to 5 years and see what we get. Okay. So I see that I think we had, okay. So it did increase over a 5-year time span. So expected mean $40 price, median price 36, lowest 18, 5% chance it could get to 18, another 5% chance it could get to 77. Let's kind of skip this and just go to what this means for an investor. There was a wide range of possibilities, significant drop, should we prepare for a bit of uncertainty, consider your risks. In short, the stock could reward patience and risk-taking, but also could lead to notable losses. Be deliberate in how much exposure you allow it in your portfolio. Okay. So again, as you can see, this is something maybe you got to play with, massage, decide kind of what you want your starting price to be, what kind of ticker you're using, and what company you're trying to evaluate. Just think of your time horizon. Maybe it doesn't always have to be in 1 year. It could be 5 years, 10 years. Again, the longer, if you are like me, who was a buy and hold kind of person, you're okay with 5, 10, 20 years, whatever it may be. I think you keep usually the steps the same. The simulations, I think you can play around with. Let's try and play around with the simulations real quick. Let's try 800 and see what we get. So now again, right, the simulations are now saying, or based off the simulations, right, we did 800, changed it, 39, I think this was 40 in the past, and clearly it went down $1 and some change, I guess, or maybe some change. So yeah, it could change the pricing 100% depending on what variables you play with here. And again, this is kind of based on your own discretion. 7% returns you stay the same. Volatility, I would assume, stays the same, but your time horizon and your simulations would stay the same, I'm pretty sure. Now, the number of steps, I believe, is the number of trading days in a year. And since the stock market is usually only open 5 days a week, right, Monday through Friday, and is not open on holidays, this takes the case of only including days that the stock market is operating. So that's why it's 252 rather than 365. But I'm pretty sure 252, or the steps itself, represent the number of days that the stock market is open. So anyways, I hope this can be used for your own stock trading or your own kind of exploration. I hope that you can maybe use this in your own financial engineering projects, or maybe just in your own projects you want to use for your portfolio. Highly recommend using it and checking it out. If any of this information was helpful to you, interesting to you, fun to you, please make sure you pass this video on to someone else that might need maybe inspiration for another project idea, or maybe inspiration for whatever they're doing at work. I will make sure to include this code into my GitHub. And I'll make sure I leave the description to the video that discusses markup chains. Really interesting video. You should check it out. And with that being said, bye-bye.